Welcome to everyone tuning in. Thank you for joining us. My name is Bryan Shipley. I'm the co-CEO and Chief Investment Officer at Arnerich Massena, a Portland-based investment advisory firm bringing our unique and disciplined process to private clients and nonprofit endowments and foundations. Today, I'm here to talk about the role of the US dollar as the world's reserve currency may be changing and what this could mean for investors. Since the 1940s, the US dollar has been the world's leading reserve currency held by central banks and financial institutions around the world. US dollars are the most widely held currency for pricing and settling international transactions. Always liquid and in high demand, the dollar is backed by the full faith and credit of the United States government and can be easily exchanged almost anywhere in the world. And while there are hundreds of competing currencies in use today, none have earned the same level of acceptance as the US dollar. Some, such as the Chinese yuan, are not freely convertible, while others have limited reach or lack of scalability. Having the world's leading reserve currency provides a lot of benefits to American businesses and government, including lower transaction costs and easier access to capital. And perhaps most importantly, the world's ever-growing demand for US dollars has made it possible for the United States to run very large trade and budget deficits, and this has allowed Americans to enjoy a higher standard of living. The dollar's dominance has also enabled the United States government to project power through economic sanctions. The United States currently has sanctions in place against more than 20 individual countries, as well as activities such as terrorism, nuclear proliferation, election interference, and crime. But while economic and financial sanctions are often effective, they can sometimes be worked around. And lately, it's been this desire to avoid US sanctions that has given rise to a new trend of de-dollarization, where countries are increasingly choosing to trade in their own currencies rather than use the US dollar. Plus, there are many other factors, such as deteriorating Saudi relations, China's rising new power, new digital currency technologies, and rising US debt levels that are raising questions about the future of the US dollar. So where are things heading? In this chart, we can see that since the 1960s, the US dollar has consistently been the world's leading reserve currency. But since 2000, the dollar's share of world reserves has been gradually declining from 71% in 2000 to 58% today. We are also seeing that the currencies of China, along with resource-rich Australia and Canada, have lately been gaining share. The big question then is, will a new surge of de-dollarization cause this trend to accelerate? We think it's possible, and here's why. Since the Russian sanctions went into effect last year, there's been a widespread movement towards using non-dollar currencies for trade. In recent months, China, Saudi Arabia, Russia, Brazil, Argentina, South Korea, Indonesia, and others have been signaling their intent to move away from the US dollar. And while this may not happen overnight, this trend seems to be gaining some momentum. So, if countries are now looking to use their own currencies instead of the dollar, does that mean the dollar's exchange rate will decline? In this chart, which shows the US dollar's exchange rate over time, we can see three things. First, we see that as of the end of May, the dollar was still relatively strong by historical standards, despite the talk of de-dollarization. Second, we see that the US dollar often rises during crisis situations, such as the Lehman failure in 2008, the COVID outbreak of 2020, and the Ukraine invasion in 2022. And third, we see that since peaking last October, the exchange rate of the US dollar has been declining. And while we attribute most of this recent decline to the slowing pace of Federal Reserve rate hikes, we think it is possible that the future declines could accelerate due to de-dollarization. So, how might this affect investments going forward? But before we talk about the possible impact of de-dollarization on investments, we need to remember that the US dollar is just one of many moving parts in the world economy, and that there are many possible scenarios that could play out over the next few years. So, with this in mind, let's look specifically at how two de-dollarization scenarios could affect investments. Here's a hypothetical look at what could happen if de-dollarization either accelerates or reverses. In a scenario where the de-dollarization trend accelerates, we'd expect the US dollar to weaken. This could mean higher import prices and higher inflation. Higher interest rates could also be required to defend the dollar to fight inflation, and this could lead to a weaker economy. A declining dollar and rising import prices could allow commodities, foreign bonds, and non-dollar currencies to perform well at the expense of the US bonds and the US dollar. But that's just one scenario. What happens if something such as a crisis causes de-dollarization to slow or reverse? In this scenario, the dollar could strengthen, while inflation and interest rates could fall. Here, dollar bonds could perform well at the expense of commodities and foreign bonds. So, how might this affect our strategy? For US-based investors, the de-dollarization story is a reminder of why global diversification is so important. By investing internationally, an investor can gain access to currencies and economies that can benefit from de-dollarization. By diversifying by asset class, an investor can manage the risks of each asset class. When it comes to diversifying during a period of possible de-dollarization, we think there's value to be had by including real assets within a portfolio. Real assets are tangible resources such as commodities and real estate that have inherent physical value that is largely independent of currency. So, in summary, we think these insights reaffirm our current approach to investing overseas, and they are shaping our approach towards real assets. As always, we continue to build portfolios with an eye to the future and will continue to explore strategies and asset classes that can enhance diversification in our client portfolios. You can visit our website at arnerichmassena.com and check out our blog for more interesting podcasts and articles on relevant topics. Thank you for joining us today.